Good morning to all. Let's start today. Last week we discussed about credit policy and then we discussed about the type of borrowers. Today we are going to discuss about type of products what we can offer to customers. When the bank decide which kind of products we are going to offer to a customer, we will look at the funding requirement, like the cash flow requirement or the asset which we are going to finance using our funding, right? Based on that, we will decide whether we are going to give a customer a long-term loan or a short-term facility, right? When we are to decide that, you can see the board properly. And suppose when we are to decide, we look at the balance sheet, fixed assets. Can you see the board properly?
Yes, sir, we can see.
Can you see the board?
Yes, we can see it, sir.
Hussein can't hear you.
Yeah, we can see it clearly, sir.
Just text me, I'm on the text box. Is the board clearly visible? Okay, right, thank you. So we have land, building, machinery, vehicles. This is our fixed assets. Then we have our current assets, right? Inventory, right? Then we have debtors, all other things. So our aim is to finance this part or this part. This can be financed through current liabilities, creditors, and STLs and ODs, right? Then we have the short-term facility here. Then the other part of the balance sheet, finance by equity and term loans and leases, right? So what is the current liability? Current liability is a liability which needs to be settled within 12-month period, right? So fixed assets, we have a life of more than 12 months, right? So useful life is greater than 12 months. Here, current assets are where we can convert the asset into cash within 12 months period. That means useful life is less than 12 months, right? So similarly, term loans repayment will be more than 12 months, whereas short term it is less than 12 months. So whenever we want to invest on a fixed asset, we go on this one as bank funding. Whenever we want current assets to be financed, we go on short-term funding, right? We will not use this to finance this part or this one to finance entire this part. We may be financing part of this which is the permanent working capital part through this, but not the entire amount. When we are financing the permanent working capital also, we are not looking at very long tenor. It is a medium term loan, which may be less than 36 months. Right? That is the ideal case. Whenever we are financing the permanent working capital, we go for medium term loan. Whereas for the fixed assets, we go for term loan, which is more than 36, maybe 48, 50, 60, 72, whatever. Right? So what the key point message to carry is, whenever we are financing a fixed asset, we will consider term loans. Whenever we are financing short-term or current assets, we use short-term funding. With the exception, permanent part of the working capital, we will finance through a term loan, which is a medium-term loan. Right? So this is how banks should match the funding requirement. When I put on you on the presenting mode, you will not see the board. Samindri? Still, I have not put the presentation on. I just wanted everyone to look at the board. Is it okay? Right? So the key message here is bank should be looking at financing based on the lifespan of the asset. Okay, we should not, sometimes it happens, but we should not allow the customer to borrow short term and finance long term. In that kind of a scenario, what happens? Your current ratio would be less than 1, negative current ratio. Right? So always remember this. This should be the way we have to look at funding. Right? Let us go to the presentation now. Can you see the presentation? Can you kindly on someone mic and let me know?
Yes, sir, we can see.
Right. Let's start. So we will be looking at classification of advances, and I will go into details of some advances, selected products. Right? Bankers try to match credit terms with the borrower's specific needs. That's what I explained. Long-term financing needs are financed with long-term loan. Short-term needs should be financed with short-term facilities. Then we can divide the facilities we can grant to two types, which is direct advances or direct facilities, and the second one is indirect advances. We have different names. Direct advances, on balance sheet facilities, right? Then indirect advances, off balance sheet, contingency. We use all three words for the same thing. Indirect, off balance sheet, contingent liabilities, right? That is, so what is the direct facility? Direct facility is a facility where when the facility is granted, money flows out of the bank, right? We are giving a facility, customer can take out money at any time. Okay, so there will be an effect to the cash flow of the bank. As example, I will give you a term loan, 5-year term loan or a housing loan. So the customer, borrower, can take out money. So bank's cash flow will come down, customer will take the money out. Okay, so in indirect facilities, cash goes out and we earn an interest income, right? Then indirect facilities or off balance sheet facilities or contingency facility, we are not giving out money, we accept a liability, right? As a bank, we accept a liability on behalf of a customer. If customer dishonor the agreed contract or performance of something, we will pay a compensation. On the indirect facilities, what happens is bank is not giving out money at the first instance. Bank is undertaking a liability on behalf of a customer. If customer does not, or like we say, if the customer dishonor the other party, we will assume the liability and we will pay. As an example, we can say bank guarantee, right? There are several types of bank guarantees. I just tell you about the trading bank guarantee, right? Normal bank guarantee, what we all know. What happens is we say, okay, I say I have a customer, Mr. Pereira, who is a distributor of DSI, right? So on behalf of Mr. Pereira, we inform DSI saying, okay, you give Mr. Pereira 1 million worth of goods on credit. If he does not pay, we will pay you. That is an undertaking given by a bank on behalf of the customer, who is Mr. Pereira, to the ultimate beneficiary, who is the corporate company. So by giving this undertaking or accepting this liability, there is no cash out. If Mr. Pereira continue to pay the company, we don't have any issue. If we default the company, company can contact the bank and say he is not paying. So we have to pay. That time only our cash goes out, right? Therefore, there is no effect to the cash flow of the bank at first instance when we are granting an indirect facility, like LC facilities, bank guarantees. All those are indirect facilities. So on behalf of indirect facilities, what bank will get is the fee income. We will charge a commission. Whereas direct facilities, we earn interest. Indirect facilities, we don't earn interest, we earn fee income, right? Those are the two types of facilities. So direct advances, we have mainly two types, loans and overdrafts. Loan is loan are granted to a customer of the bank, financial companies, or agreement whereby agreed to specific amount at a specific interest rate to pay on installment in an agreed amount at an agreed period. That means loan is a funding, we give it to the customer. We have a fixed amount. Customer agreed to pay us on a regular basis. It can be monthly, it can be quarterly, it can be weekly, it can be biannually, or it can be annually. Agreed repayment, agreed amount of repayment at an agreed rate. It can be a fixed rate or it can be a variable rate, right? It is a loan. On the loans, what happens is you give an amount, customer repay, then the loan get finished. Repayment finished. If the loan is 5 years, after 5 years, there will not be a liability. Gradually, loan outstanding comes down. Whereas the overdraft? Overdraft is not a facility, it is a limit. We mark a limit on the current account over and above the credit balance in the current account, right? So the customer can write checks over and above the credit balances he has. We say customer has a 100,000 rupee in the account and we have granted another 100,000 POD, overdraft. It can be a POD, anything, right? Overdraft. So now customer has 100,000 his own money and 100,000 bank's money, right? So customer will be in a position to write checks for the entire 200,000. When the customer deposits some money, so this overdraft is a limit marked for a specific period. It can be 3 months, 1 month, or 1 year, right? At the end of the period, you have to review. So overdraft is marking a limit of credit over the credit balance on the current account of this customer. This means the bank is paying checks drawn by the customer, notwithstanding the fact that the funds are not sufficient to honor the debt. That means above the credit balance we have. So it is a limit. It is like a bucket where you put water, take out, refill, take out, refill. So you can continuously operate within the limit given. Whereas a loan, you can't do that. Once you repay, you have repaid. You can't retake that money, right? Then there are 3 types of overdrafts: permanent overdraft, temporary overdraft, and casual overdraft. Permanent overdraft is again a limit marked over and above the customer's credit balance. We grant it at a specific interest rate. It is normally for a period of 12 months. At the end of the 12 months period, we review the customer's performance and we can decide whether to continue or on-demand payment to be demanded, right? It is not gradual repayment, it is on-demand payment on overdrafts, right? So it is for a 12 months period. After 12 months, you look at the performance of the customer and the bank has the discretion to decide whether we are continuing with this limit or we are going to demand this money, right? Normally with security, it can be without security as well, collateral. Then temporary overdraft is again the same, but it is for a very short period. Maybe not very, very short. It may be for a month or it may be for a 3 months period, right? It is a temporary facility with a written request from the customer. Temporary overdraft should be granted with the written request from the customer. Permanent overdraft, you should have a offer and acceptance, right? Temporary overdrafts can be with or without security. Mainly temporary overdrafts are without security. Permanent overdraft rates are reasonable. Temporary overdraft rates are higher because it is a temporary facility. Then the casual overdraft. Casual overdraft is not a right of a customer. It is the facility or service given by the bank to the best customers of ours, right? That means at the bank's discretion, we pay. It is for 2 days, 3 days, 4 days, 5 days, very short period. At the bank's discretion. Customers can't demand on it. Temporary overdraft, they can request. When a check comes in, whether we are paying or not is a decision of the bank manager. Right? It is based on the relationship and creditworthiness of the customer. You don't need to give a request letter for this casual overdraft. It is for very shorter period. Temporary overdrafts are for slightly higher period. Permanent overdrafts are for 12 months period. Right? That is type of overdrafts we have. Indirect advances, again the same thing. Definition is same, but why I have put indirect advances again? We have three parties: the applicant, beneficiary, and the guarantor. Right? Applicant is the customer who requests the bank to guarantee on behalf of him or her. The principal debtor, person that at whose request the guarantee is being executed. Applicant is the customer, Mr. Pereira. Beneficiary, person to whom the guarantee is being given and who can enforce it in case of a default. It is the company, DSI. Right? We are guaranteeing Mr. Pereira's requirement for DSI. So it is the beneficiary. Beneficiary is the one who can claim. Right? Applicant can't come and, once the guarantee is issued, applicant can't come and cancel the guarantee without the consent of the beneficiary during the guarantee period. Guarantor is the bank or the person who is guaranteeing the liability of the applicant. The person who undertakes to discharge the obligations of the applicant in case of his default. That's the bank. Right? Applicant is the customer. Beneficiary is the corporate or whoever the guarantee is issued and who can enforce the guarantee. And the guarantor is the bank or the financial company. Normally,
sir, hello.
Then type of advances, as I told, short term, any facility which needs to be settled within 12 months period. Then term loans, we have medium term and long term. Medium term goes maximum of 36 months. Long term can go from 12 to even 10 years, depending on the product and the requirement. But normally we don't give 10-year facilities. We try to commercial lending, we try to limit it to 5 to 6 years maximum. Then types of advances based on securities. Guarantee loans. Guarantee loans are, it can be a personal guarantee. When a person is guaranteeing someone, giving a guarantee to the bank, it is a personal guarantee. When a company, incorporated company, guaranteeing to a bank, it is a corporate guarantee. We have two types of guarantees: corporate guarantees and personal guarantees. Person himself or herself guarantee. Company, which is a legal entity, guarantee. When a company guarantee, it is a corporate guarantee. When a person, human being guarantee, it is a personal guarantee. Mortgage loans, when the facility is backed by a mortgage. There are two types of mortgages: immovable and movable. Immovable means we can't move, right? Land, building, machinery which are not bolted to the ground is an immovable machine, right? Movable can be stocks, vehicles, machinery which can easily move. That means you can move, right? So facility, short term, long term, can be backed by a mortgage, immovable mortgage or movable mortgage. Then we have pledge loans. That means stocks are given as a pledge to the bank. Ownership will remain with the customer, but the stocks is with the bank. Possession is with the bank. So that kind of a facility is called pledge loan. Ownership customer, but possession of the goods are with the bank. I will explain in detail that because we have pledge loans later, right? Any questions up to now?
Hello. Hello. Hello.
You don't have the tute?
No, sir. We don't have it.
I can't hear you today. Please text. I'm not hearing anyone's voice today. Hussein, I can't hear you. Okay, just give me 1 minute. I will get them to upload. I thought they uploaded it. Yeah, I changed the volume. Can someone speak up? Hussein, can you hear me properly now?
Yes, I can hear you, sir.
Okay, okay. Now it's fine. Volume
Okay,
was down.
right. Sir, there is a question that I need. There is a question for me, sir.
What was that?
So this now in a bank guarantee.
Yeah.
In a bank guarantee, when a claim comes, should the bank inform the applicant that there's a claim, or can we directly go and honor the claim?
You don't need to inform. It is an unconditional guarantee, right? Bank guarantee is unconditional. So as soon as we get the guarantee, we have to pay. Just hold on.
Okay, sir.
Right? Sorry, bank guarantees are unconditional, right? You can't say customer has not paid, you prove us things and all those things. If a claim comes in, we have to pay.
Okay. If there's a dispute, sir, if our customer comes and claims that there's a dispute, how do we handle the matter?
He has to solve. We get at least 2 to 3 days maximum, right?
Yes.
And we pay.
All right. Okay.
Because it is the bank reputation if we don't pay, right?
Understood, sir.
We will give 1 or 2 days maximum. Normal standard is within 48 hours, we try to pay. Right?
Okay, sir. Thank you.
Okay. They are uploading. As soon as it's uploaded, please let me know. I will start the lecture.
So generally, the tutes are uploaded later on. So it will be really helpful if we can be uploaded prior to the class.
Okay, okay. I will inform the office. Right?
Thank you very much, sir. Thank you.
Okay. Samindri, bank guarantees are uploaded. Sorry, bank guarantees are done on both ways, cashback and property back as well. So, cashback, you have liquidity. As soon as we pay, we can take the cash and settle our liability. But when it is property back, we don't have a way of taking our liability out. We first have to pay the beneficiary and negotiate with the customer to pay, right? So we can convert the liability to a 1 or 2 year loan, or we can give 2-3 months to pay. It is a secondary negotiation. At the time of approving a bank guarantee facility, we don't give a way out. It says normally, if we honor, you have to pay us, right? Is it clear? Okay. Do you have the handout now? Do you have the handouts now? Can someone tell me? Hussein?
Not yet, sir. Not yet.
P2. Okay. Right. Okay. Thanks. They have uploaded to the classroom. It says P2. Check.
It's there.
Is there?
Yeah.
Okay. Okay. Right. So then I'll start. Right. Because when I'm presenting the handout, I can't see your chat box. So if you want to ask me questions, please speak out. Right. Then type of loans based on income generation. So funding can be divided into two: consumption lending and commercial lending. Consumption lending is when the funds are used to do the to fulfill the end use. End use will not generate income to service the facility. It's like this. If we give a housing loan, once the house is constructed, if the borrower is going to live on that house, it will not generate money to repay the loan. Or you give a loan to buy a car for personal use, end use of that money will not generate money to repay the loan. So it is consumed, consumption purpose. Then commercial lending is when the end use is done, it will generate money to repay the loan itself, right? We give a loan to buy inventory, short-term facility, right? Then when the inventory comes in, you sell the inventory, you generate money and you repay. You give a loan to buy a factory. The factory will generate money to pay you our loan. So commercial lending is when the end use of money generate cash to repay the loans, then it is commercial. Consumption is end use will not generate money to repay. Consumption means utilizing the loan proceeds where end use will not generate any income. Commercial lending, financing for commercial sector is to improve an existing or new business and invest in anticipation of generation of profit. Right? This is a small summary about what type of products in direct and indirect for the corporate world or for the retail world. Fund-based trade finance facilities, export finance, project lending, loan syndications, overdraft, mortgages, leasing, factoring, all those things where money goes out. Fee-based, forex, then derivatives, IPOs, where we earn, we give a service and we earn a fee income. That is indirect facilities. Consumer side, loan, personal loans, credit card, all those things, and indirect guarantees and letter of credit, right? But consumer side guarantees are very limited. Consumption lending detail. Consumer loans in the aggregate, like currently consumer loans generate the maximum profit to a bank, right? Because commercial loans, our margins are very thin. That's why we go for commercial consumption loan. But consumption loans are very risky. Rates may default rates may go high. So most of the banks currently focus on professionals, right? That's why these all pension loans are coming in, professional loans are coming in, right? Housing loan, we have other benefits giving housing loan like that. As a whole, consumption loans give the maximum profit, but default rates are higher. Evaluating consumer loans, it is same as commercial loan. We should know the purpose. We should know the needed amount. We should know how he is going to repay, right? Commercial loans normally based on the cash flows, predicted cash flows, whereas personal loans based on the known cash flow, basically salary. However, credit card evaluation is different, housing loan evaluation is different, pawning evaluation is different, personal loan evaluation is different. There can't be a single way of evaluating. Different products will have different evaluation methodologies. These are type of facilities: credit card, housing loan, personal loans, letter of credit, like that, right? So credit card is the most common revolving personal funding, right? It is a revolving fund. We give a limit, customer can use it, or customer can settle it and reuse it. We have several credit card players in the country. MasterCard and Visa is the most common. Banks take a franchise from these MasterCard and Visa, or we have Amex, we have other things as well, but mainly these two are the main credit card companies in the country. So bank needs to take the franchise. For that, banks pay a one-time fee. Then annually, we have to pay a fee based on the number of active cards. Based on the number of active cards. So on the credit cards, bank earns several income sources. Bank will have several income sources. Joining fee, Then annual fee, outstanding balances, bank will charge interest. Then when you use a credit card, there will be a discounted amount, there will be a charge from the merchant side, not from the customer side. Like you go to House of Fashion, purchase goods for 100 rupees, you pay 100 rupees. But bank will give the merchant, that is House of Fashion, not 100, it is only 97, 3% margin. So we take out that, keep that markup and give 97 rupees to House of Fashion upfront. Then this money, 3 rupees, will be divided among the card issuing bank and the POS machine owning bank. Right? Let us see that. This is the process. Right? You are here, the individual, that's you. You go to retail outlet, that is House of Fashion. You buy the goods, give your card. If it is a NDB card and the cashier swipe that card on the POS machine, right? If the POS machine is NDB, merchant bank also NDB. If the POS machine is BOC, merchant bank would be BOC, and the card issuing bank would be NDB. Right? How it goes? You go to House of Fashion, purchase 10,000 rupees worth goods. Right? You give the card. If it is NDB POS machine, it goes straight to the card issuing bank. From card issuing bank, retailer will get 9,700 rupees. Card issuing bank will charge 3%. If it is 3%, entire 300 rupees is their fee. If the POS machine is Sampatto Bank of Ceylon, this bank will immediately credit House of Fashion 9,700 rupees. Now they have charged 300 rupees. So this goes through the clearing house, clearing network to the card issuing bank. Card issuing bank will reimburse the merchant bank, Sampatto Bank of Ceylon, keeping a commission. Out of 3 rupees they earn, Sampath will get, NDB will get 1.501%. Right? So they will get 9,850. Right? Because they got 3. Then we are going to share the fee among the merchant bank and the card issuing bank. And card issuing bank will charge 100 rupees to the individual. So that is the process. We will have card issuing bank and the merchant bank. So for this, we are using the MasterCard network or the Visa network. For that, annual fee has to be paid to the merchant, where it is based on the number of active cards. So this is the steps involved in credit cards. Right? Then you have the home loans. Home loans can be granted for anything related to your housing. House purchase to land purchase to land purchase to construction to value addition to anything you can, and based on the repayment capacity of the borrower. Normally, it is the salary or income. Housing loans are longer tenor normally. Personal loans are shorter tenor. Right? Normally it is up to 5 years, but now we go up to 7 years. It is unsecured and higher rate. Then we come to the commercial lending. These are few breakdowns of commercial lending. We have long-term lending, we have short-term lending, we have asset-based lending. So we will be discussing all this. Long-term lending is lending, as I told you, about 12 months. Right? It is about 12 months. Right? You can have starter loans and expansion loan. Starter loan is a loan given for startups to start a business. Right? Expansion loan is for an existing business where they want to expand or modernize their capacity or the production. Right? For an existing business. So normally all long-term loans need to be backed by a security. It's given for fixed assets and permanent working capital. Normally for loans which are granted for fixed asset financing, we give a grace period where customer needs to pay only interest during that period. Grace period is given to the capital repayment. From the day one, customer needs to pay the interest. Only capital can be deferred, right? Because banks' bread and butter is interest income. So we sell cash, we sell money, we need to earn a return, right? Long-term loans will be repaid over more than 12 months. Normally it comes with a grace period, with the exception of if we are giving to purchase a land, we hardly give grace periods. If it is for working capital, we hardly give grace periods, right? It is for long. Long terms are divided into startup loans or modernization or expansion loans. You need to have a solid security normally for long term. Like I'm telling you the general case based on the credit worthiness of the customer relationship and everything, we can change that. But in general, we need for long term, you need to have solid security. That is immovable security. Right? Then we will go to this short-term financing part. Mainly short-term financing is to finance the working capital. I showed you short-term funds to be used to finance the current assets. It can be a limit or it can be a off-balance sheet facility, or it can be a medium-term loan. It can be a limit, it can be a medium-term loan, or it can be a off-balance sheet or contingent facility, non-funded facility like bank guarantee. All are used to finance the working capital. Then we have the asset-based product like vehicle leasing, hire purchase, equipment leases, where we lend based on the asset we are financing. The lending decision is mainly taken based on the asset financed by us. Right? Previous two things, it is purely based on the credit worthiness of the customer. But asset based, we look at the asset first, take okay, this much can be granted. Based on that, we will look at the credit worthiness. Right? Gold loans. For pawning, you don't ask the customer how you are going to pay. You look at the gold. Right? On leasing, what is your first question? What is the vehicle? Not how much can you pay. But short term and long term, how much can you pay? Then only we will look at the other part. Right? So it is working capital. We will have a detailed lecture on working capital, day-to-day funding. Working capital is the funds required for day-to-day operation, to run the day-to-day operation of a business. Right? So we have two things. We have basically three things: manufacturing entities, trading entities, and service entities. Right? So from manufacturing entities, how it happens is you have cash, you buy raw material convert into work in progress, semi-finished goods, then it will become finished goods. Then you sell on credit and you will get debtors or account receivables. You collect that, you get cash. This cycle is called working capital cycle. Whereas trading business, you have cash, you buy finished goods, sell that, you get account receivables, you collect cash. So this is shorter than this one. When it is service industry, even finished goods are very small. It is only some inventory or something. So it is straight away to account receivable like that. So it was like this, smaller, and the other one was further smaller. Right? So we have something called operating cycle, cash conversion cycle. We look at those things when we work on the working capital, right? This cash conversion cycle and operating cycle or the working capital cycle is used to define the period to be given to repay, right? It is defined, used to define the period to be given for the short-term facility, whether this is a 90-day facility, 120-day or 180-day facility. That is decided by the cash conversion cycle, right? That's all on working capital for the time being. When I come to working capital, I will take you more with that. So we have cash flow based lending. This is called channel financing, right? This is the entire channel from a manufacturer to a corporate to a seller, right? I'll take an example of DSI here. A corporate company is the DSI. You have Saman Shoes who is manufacturing shoes for DSI, right? So before going there, we will discuss this. I am a shoe manufacturer, okay? And you are my banker. I come to you and say, I have an order of 1 million rupees. I need 800,000 to do this order. Can you give me money? Think, how comfortable are you to give me money? Right? Your mind will run and see, will he take this money and do the order? Or will he use that money to do something else? That is called performance risk. Will this customer do the order what he say? Is it a true order? Right? Then the same way, I will come and say, I am a supplier to DSI. I have done this order, 1 million worth. After a month, DSI will pay directly to the bank account. This is the agreement from DSI to pay this 1 million, all their payments to your bank account, my bank account with you. And this is the proof that I have submitted these goods. This is my GRN, good received note. DSI has checked the goods and taken in. Now it is a matter of paying. But DSI will not pay cash. It will take 1 or 2 months to pay. So as a manufacturer, I have other works to do. I have other orders to continue. So I need money. I need to pay my salaries. I need to feed my kids, right? So I need money. So there will be a working capital requirement. Manufacturer gives goods, receive the GRNO, post-dated check. PDC is post-dated. Similarly, DSI canteen. I provide lunch, but DSI will pay after 1 month. So I have given the service, I am waiting. You have this thing. So there is a funding requirement. This red part, you have a funding requirement. So a bank can look at this funding. You can get the money from the corporate company to the SME's account with the bank, right? Normally what we think, when a corporate company issue a GRN or a post-dated check, they will honor. Therefore, we have a comfort of getting money, right? So we have a short-term period. We know within 1 month or 2 months, we will get money. We know the timing, we know the amount, right? Known cash flow. Based on that, we will pay the smaller person, the manufacturer. We may pay 75% or 80%, not the entire thing, because we have to take our interest portion. Therefore, we are not paying the entire amount. We reduce the profit part and pay. So when the money comes in from DSI after a month or 2, we will deduct the amount we paid earlier and we recover our interest part. If there is a balance left, we will hand over to the customer, right? That is the supplier side. So we call it supplier finance. We supply, there is a credit period, we will bridge the gap on that credit period. Similarly, on the distributor side, which is your left-hand side of the dotted line, DSI will not go everywhere and distribute. There will be agents, distributors, right? DSI will give goods on a credit note. On credit basis, I am a distributor of DSI. I get my goods from DSI on 1 month credit. But I need to give DSI a comfort. I need to give a bank guarantee to buy on credit. Then it comes to off balance sheet bank guarantees, right? As a distributor, I need to give a guarantee to DSI. So once based on the guarantee they give me goods, I will go to the market, sell everywhere, but I will not get money. I will get again post-dated checks, right? Or I will sell bill to bill. So I don't have money to repay DSI when it comes. So what happens? Then again working capital requirement increases. Then what the bank can do is, you can collect the post-dated checks. By collecting the post-dated checks, you know how much is due to this customer, and based on that, you can give a part of that money, which can be used for their working capital. So here, what happens is, distributor distribute goods among large number of people. So the risk has been dispersed. If the distributor gives to one person, it is a concentration risk, concentrated. One person, if he does not pay, we will have problems. But when there are large number of people, what happens? One or two people does not pay is not material to us, because risk has been dispersed. Right? So what happens? We will take those post-dated checks and give money to the distributor. Then when the checks get realized, we will recover our capital, what we gave, and the interest due on that capital. That is called distributor side or distributor finance. Receivable finance, distributor finance, different words. Is that clear to you?
Yes, sir. Sir, question.
Yeah.
Now, in a scenario which you explained now, where a bank guarantee and a it looks like a TOD is also needed. If that is so, can you give both facilities to this customer?
Yeah. See, bank guarantee is to cover the right. See, we give bank guarantees to cover this part, creditors. Right? Here DSI is the creditor. Right? DSI need the comfort that my trainer shoes will pay. Right? So DSI need that comfort. Therefore, bank is giving a bank guarantee. Right? It is only a comfort. Okay? So they get the goods. We give the bank guarantee. DSI will release goods. So your inventory goes up. Right? When you sell the inventory, your debtors will go up. Okay? Cash. Then after 30 days, we say debtors are 45 days. Okay? So on the 30th day, DSI, we need to pay DSI. If you don't have cash, well and good, we pay DSI. If they don't have cash, there has to be a way of, because this is 45 days, this is 30 days. If it is 7 days or 14 days, by the time you need to pay DSI, we have collected cash. But if it is more than that, by the time you need to pay DSI, your entire cash has not come. Right? So what we do in this kind of a scenario, you can give a distributor finance facility. Right? Like post-dated check discounting. Right? Which I just explained to you. So you take bank takes the post-dated checks, PDCs. We say we have 1,000 PDCs worth 100,000 rupees. Okay? 1 million, we say 100,000 is small. Bank takes these 1,000 PDCs worth 1 million rupees. Okay. What we do, we take the PDCs, look at the PDCs, we check the dates, we check the amounts, right? From whom we check. Okay. Then, based on the customer's check return percentage and the profitability, we give a percentage. We have 1 million, we will give 80%. We say customers check return percentage is only 5%. Right? So it is comfortable. We are not giving 20%. Right? So I will give 800,000 rupees to this person. You will get cash 800,000. So you can go and pay DSI on the due date. When the checks get realized, I will take out this money plus interest. That is how the post-dated check business operates. Similarly, you can give a POD. Right? That is a very common word among the business people, POD. When a POD is given, we don't know how it will be settled, when it will be settled, we don't know anything. We have just given a bucket. Right? They can take out money and they don't need to look at us. Right? But here in PDCs, we know the amount, we know when it will be due, and if these checks get returned, we know the cash flow issues. Right? So this is very good self-liquidating mechanism. This is a bucket. That's why we would like to go to this than PODs. Normally, medium terms and PODs are used to finance the permanent working capital requirement. Right? Day-to-day funding should be done like self-liquidating thing, then it is easy for banks. Did I answer, Hussein?
Yes, sir. Thank you very much. Yes, sir. Thank you.
Any other questions? Please participate. Get clear. We have more time. I just want to give you knowledge. Okay. So I'm giving you knowledge for your day-to-day function. In that process, right, you will pass the exams. Don't follow this course thinking I will pass. I just want to pass, not a knowledge. Right? Because we meet people in interviews coming and saying I have AIB, I have passed credit. Right? One question, they fail. Did you go to the class? No, I just went through the past papers and passed. So it is an insult to the institute, insult to the teachers, lecturers who are teaching. Yes, we get some fees from the institute, but we have to do honors to that and the service. Please ask questions and clear all your doubts. Get knowledge. You have long way to go. I have few years to retire. Before that, I want to give all my knowledge to you and go home. Right? Use the knowledge. Knowledge is the key for success in this era. Okay, let us go back. So we discussed the supplier side, then we discussed the distributor side. So this kind of thing is called cash flow based lending. We discussed cash flow based lending on our first day as well. So this is the similar thing. In that, we know this is the known cash flow based lending. We know the amount and we know the timing when this cash will come to the bank, right? Then we have something called factoring. It is one of the famous but high cost way of financing the short-term assets or the fixed assets, current assets. I'll read out it first. Factoring is defined as the continuing legal relationship between a finance institution, the factor, and a business concern, the client, selling goods or providing services to trade customer, the customer, on open account basis, whereby the factor purchased the client's book debt, account receivables, either with or without recourse to the client, and in relation thereto control the credit extended to customers and administer the sale ledger. This is a definition for factoring. It's like this. We have the factoring company or the bank. We say bank, right? Then we have customers. Okay. We have customers, trade customers, and then we have our client. Right? We have, these are the three parties factor. Okay. So customer will sell goods. He will receive a invoice or debit note, right? Now he sells, he get a accepted invoice. We say it is 30 days. Goods for 5 million rupees. So customer can wait for 30 days and get this money. Right? He has a timing difference. He needs working capital to run his business. He sells and he has to wait. Okay. Now he can come to a bank and say, I sell shoes and I have these customers and they are paying me after 30 days. So the factor can evaluate these customers. The client can say, I have customer A, B, C, D, E, F, like that. I have so much customers. So factor or the bank will evaluate these customers and say, okay, this is a good customer, this is a bad customer, this is a good customer, this is a good customer, this is a good customer. This is a good customer. You go and sell to these customers, we will provide you cash upfront. You can sell up to 500,000 to this customer. You can zero for this customer. For this customer, 700,000. For this customer, 1 million. Like that, you can give limits to each customer. Factor will give based on the evaluation factor will do on this customer. Right? So factor will decide to whom this seller is selling. Right? If trainer shoes goes and sell to B, he will not get money from the bank. He has to bear that money. After a month, he can wait and collect. That is his problem. We are not looking at that. Now, once the bank decided, okay, I am going to finance these people, on this accepted invoice, bank's name will appear. Bank's name. Name as the factor. Right? So this customer will get to know that client is going to get money for this invoice. It is stated in the invoice. Right? So what happens? Client brings this invoice to the bank. Right? Invoice to the bank. And banks give money, cash, as a percentage of the invoice. Right? Then at the end of the period, customer needs to pay to the bank. If it is 5 million, customer needs to pay 5 million here. Invoice value is 5 million. Invoice value 5 million. I will give 4 million here. At the 30th day, customer needs to pay the bank, not the client. Right? Once the bank get money, we will deduct this 4 million. We are left with 1 million. We will take out all the charges he needs to pay and we will return the balance. Right? This is the process of factoring. Right? We have a word called recourse. Recourse and non-recourse. Non-recourse means if the customer does not pay to the bank, we can't go behind the client and ask for money. Right? It is bank's problem. Bad debt is bank's problem. Whereas recourse means if the customer does not pay, bank can go back to the client and say, your customer did not pay, you pay. That is with recourse. Normally factor is non-recourse basis. Right? If the customer does not pay, that is bank problem, you go and collect, don't come to me. Right? In this process, customer will get to know that his invoice is factored. Right? So they are getting money upfront. That he will get to know. And he has the obligation to pay to the bank, not to the customer, because it is stated on the invoice. Bank decide to whom client should sell and the amount. So debtor management happens from the bank side. If it is non-recourse, bad debt will be gone out of these books. They have received money, so there is no bad debt. If it is recourse, bad debt is accounted here. So this process is called factoring. The customer get to know that money is taken from the bank and they need to pay. Right? Any questions on this?
So the invoicing, when you say invoice, the first step, when the customer gives, the client gives good to the customer will give an invoice to the client.
Client will give the invoice and customer will accept it. Once the goods, they will give a, like when you are purchasing something,
yes,
always the purchaser will give something, except it is on the credit.
Okay.
Right?
Okay.
So some sort of a document to say that I have given you this amount of goods. You need to pay me after 30 days and this will be factored at this bank.
So that I mean in that, because I mean now after this particular transaction happens, only the client goes to the bank, isn't it?
Yes, yes. So
Then
firstly, what happens is client will come to the bank and say, these are my customers. Can you look at these customers?
all right.
They have to arrange everything first.
Okay.
Bank can refuse some people. Say that I'm not going to touch these people. So we have to do our independent studies on the customers. Once this is in place, they can go to the customers and say.
Understood, sir. So bills discounting and this, is it the same or is there a difference?
There is a slight difference. Once I finish, I will go to that.
Okay, sir. Thank you.
Right? Any other questions to anyone? If you don't want to let others hear your voice, you can text. You use whatever the language you want, not Tamil. I can't speak Tamil. Whether English or Sinhala, you can ask. Don't worry about language. But better to have the language, but still, in order to get the knowledge, you use whatever the language you want. Okay, English medium class එකේ ගහන්න ලැජ්ජයි කියලා හිතන්න එපා.
So තව එක ප්‍රශ්නයක් තියෙනවා now when it
No
comes
questions,
to
everything
evaluating
clear? Very
those
good.
customers,
Yeah.
then so there is, hello,
කොහොමද evaluate කරන්න
hello,
කියන
sir.
එකනේ. Yeah, කොහොමද evaluate කරන්න කියන එක.
When you when from the
How are
bank's
we
point
going to
of view,
evaluate?
when
That's
you
your question, right?
evaluate the customers, sir.
Yeah, it is bank.
Yes, that's
how
the
we
question.
evaluate the market information, those things, those kind of things. We won't have access to their documents, but through the market intelligence and known parties, we will be able to evaluate them. Right? So like we can get their from him some registration details or something. We can call a CRIP report. Those kind of things we will have to. Yes, it is like, let me finish that part. This is the factoring process, Aruna. PDCs and invoice discounting, I will go after this. PDCs.
Okay, sir. Understood. Thank you, sir.
Right? Right? Anyone else? Any question? Does the bank allow factoring for all type of customers? It is for normally good customers only. This is risky because bank will have to assume the bad debt. Right? It has to be fast moving good. It has to be good without which you can't run the business type. Right? It is critical good. Otherwise, all things we will not. Because this is a clean basis facility, not we don't have any other way of collecting our money. Okay. Sanish, did I answer you? Factoring gives lot of benefits. We charge interest, we charge fees, lot of fees. This is very costly. Factoring is normally very costly. Factoring can, maybe within a month, it is like a facility evaluation. You do evaluation on this, you do evaluation on this. So within a month or 1.5 months, we should be able to get a factory. Once the limit is in place, financing is very fast. Okay, Manisha. Right? So let us now within the factory, we have two things: PDCs and invoice discounting. Right? It is also on the same thinking line, but when it is coming to invoice discounting, this one is not there. Right? It is not there. Customer will not know that client has discounted the PDC. So he will pay to client bank account. And in turn, the client will pay the bank. He does not know that he is paying directly to the bank. He is paying to client's account, and from the client's account, we will get our money. The difference between these two are this: customer will not get to know the factoring arrangement, whether his invoice has been discounted, it is not known. And he is not paying to the bank, he is paying to the client. Client in turn paying the bank. Bank will not go and collect from the customer. Bank's collection is this. It is with recourse always. Right? Hussein, clear? That was your question, right? Hussein? That is invoice discounting. Right? Then the other question was PDCs. Is it almost like PDCs? Aruna? Yes, it is. Here normally it is invoice. Then you have PDCs. Customer gives a PDC to the client. He will bring these PDCs to the bank, right? We can decide whose PDCs are taken.
Clear, sir. Clear.
Normally,
Thank
it is
you.
not who.
Yes, sir.
Okay, right? In the factoring business, we decide
Yes, sir.
whose
Clear.
things are taken. Okay, right? But under PDCs, we can't decide whose PDCs. We don't go on to that detail in PDCs, but even PDCs, we check who are these customers, right? So we have client-wise, customer-wise limits and maximum amount on a PDC. We can say, okay, each customer will have only one. We are talking about a 10 million PDC line, right? I will say each customer will have only 500,000. So I am dispersing my risk. I am taking a risk of a customer only 500,000, not more than that. Each check should not exceed 50,000. That is my limit. How you decide this one? The percentage, how much I am giving from 50,000 check, I am giving 50% or 20%. It is decided based on check return percentage, right? If it is 5%, 3%, like that, we will consider. If it is 10 to 20%, we hardly consider. Then we need the check return percentage, then we need profitability, right? If your profit margin is 20%, we will go below 80% of discount because we are not giving the profit component. We are giving only the cost component of your invoice, right? So on PDCs, what we do, we take some initial deposit. We say we take 10% initial deposit. So if out of the PDCs 90% realize, still you are bidding. You say you are discounting only 80%. So here you have 10%, here you have 20%, total 30%, right? If out of the PDCs 70% get realized, you recover your capital. That is how PDC line operates and the difference between the PDC and the factoring or invoice. Is it clear? Sanesh, factoring is a clean facility because it is a non-recourse. Sometimes it depends, everything depends, right? You can ask for some sort of a collateral. When you ask for collateral, it is a recourse, right? It is a recourse. Factoring is normally non-recourse. Is it clear? Okay. Anyone else? Okay. If no questions, I will go to the screen. The factoring explanation, it is the outright purchase of credit approved accounts receivable with the factor assuming bad debt losses. Factor provides sales accounting services, use of finance and protection against bad debt. I told you, we will decide to whom we are giving money, and bad debt is borne by the factor. Factoring is a process of invoice discounting by which a capital market agency purchases all trade debtors and offer resource against them. Invoice discounting 70-80% depending on the margin, profit margin, right? It is not flat 70 or 80%. It is based on your profit margin because you are not giving out money, right? These are very common questions when you come to promotion interviews and all those things, right? Blanketly 80%. No, පුරුද්දට දෙන්නේ 80% අපි සාමාන්‍යයෙන් දෙන්නේ 80% නෑ. ඒකට හේතුව මේකයි කියන එක තමයි you should know. The advance against copy invoices, because we are not looking at getting money and the customer will not know we have discounted. Debtor pays directly to the client seller and in turn seller pays the bank. Seller need not to disclose that he does discount to his debtors. Check purchasing. Check discounting and purchasing are two different things. What I discuss is check discounting. Check purchasing is a very short term. It is on the word of the issuing bank, right? Today, customer comes to us with a check and he wants money. What we do, we will call the other bank and see the possibility of getting this check realized tomorrow, right? It is a day or two maximum. For that, we charge 0.5%, right? So it is on subject to sufficient funds availability, conduct of the account, and status report of the bank regarding the client of issuer. So normally when we confirm the fate, we don't return, but there were instances where we have returned the checks as well, right? That is bad banking, right? Normally when we confirm the fate to another bank, we honor that check. So that is check purchasing. Post-dated check purchasing, that is the other one we discussed. PD, discounting. Trade related checks only. You have to make sure this. It has to be trade related. So wherever we went wrong, we have not identified the customer properly. Personal checks has come in. So they play with us with these checks. Ideal for distributors who engage in wholesale distribution. Larger number of customers. Source of funding for working capital 70-80% again based on cash deposit, cash margin, check return history. Then we look at maximum value per check, maximum limit per dealer are some controls. Then we have pledge loans, right? Now we go to pledge loans. Pledge loans are facilities where goods are given as bail to the bank. I will take you an example of the famous pledge in the country, which is the paddy pledge, right? I will explain through that. right? You have a warehouse. I'm not good at this. 2 keys. Key 1, customer. Key 2, bank. Right? It is dual control. Stock will be held at a dual control or at the custodian. At the moment, I am doing a pledge with one of the distributors in the country. I have a custodian, and right, that company is holding stock on behalf of me, right? So I have given out money. I gave, we say, 100 million rupees to purchase goods. We say water bottles, right? I have a customer A. I have given 100 million to him to purchase goods. This goods is kept in a warehouse where he can't touch that goods alone. The ownership is with them, but possession is with the bank. Bank can't hold it in our, we don't maintain warehouses. So you can have a custodian, or you can have a warehouse of clients themselves, and we need to have dual control in that case, right? So we say it is water bottles, right? So this customer, bank has given money. Bank has given money to this customer to purchase water bottles. This stock has come to the warehouse. It is under the control of the bank now, right? So when this customer wants to sell, first he has to pay the bank. We say he has a sale of 10 million rupees, right? He has to pay the bank 10 million first, or give a delivery order from a reputed bank. So he can sell. First, he needs to bank needs to be settled. Then only the goods will be released. So the under pledge, ownership is with the customer, but possession is with the bank. That is called a pledge, right? So normal pledge page is that the bank gives 100 million for, we say, Arya Sahara or Nipuna Sahara, right? We give 100 million. They buy paddy and they store somewhere. But once they bring the stocks to the stores, they can't alone take out money, take out goods. It is under the control of the bank, right? When they want to sell paddy or take paddy for usage, they need to settle the bank. Then bank will release goods to the customer. So ownership lies with the customer, but possession is with the bank. That is called pledge facility. Paddy pledge is one of the famous pledge in the country, but it is very dangerous because these people will rob. We have a door here, they have a door other side, they take out money. Then maintenance of the quality of the goods lies with the bank. If something goes wrong and something has happened to the goods, there will be no goods to release. Then we have an issue. Right? That kind of practical issues are there, but without collateral financing, collateral funding, working capital, this is a good mechanism. What I have done currently, I gave a 500 million facility to buy some goods to one customer. I have selected Haley's warehousing. I gave the money, he took the goods and goods were delivered to Haley's. They are maintaining the stock on behalf of the bank. So they charge something, customer needs to pay that, but without security, I gave this 500 million, right? Within 2 days, I gave that facility because no security requirement, anything. We just evaluated customer's background and gave money. Now goods are with us. We can sell it at any time if he does not pay us after the due date, right? So whenever he needs money, he pays the bank first and I give an order to Haley to release. Like that, it happens very smooth. So it is called pledge loan. The 1 minute to then. The other famous pledge is vehicle pledge. When we had a lot of vehicles in the country, we didn't keep the vehicles with us. We kept the documents with us. Without the original import documents, they can't go and register in the RMB. So vehicles were lying on the car sales, but documents were with the bank. So whenever they want to sell a vehicle, they have to pay the bank or give a delivery order. Then bank will release the documents. Right. Okay. Any questions now?
Sir, with regard to this, when you are keeping these goods, I believe it has to be insured. If it is so,
Yeah,
who should
all
insure
those things
this?
has to be done. Insurance has to be done. Everything has to be done.
So who should do the insurance? Is it the bank or the client?
It is the customer. All bank normally does not bear any cost. We only earn. Right? All things have to be borne by the customer. Right?
Oh,
Yeah,
right,
white
thank you.
collar money lenders.
So normally, how much do you charge for the pledge loans?
Haley,
No, the bank.
it depends. Like it is a short-term facility, no? Based on our cost of funds, we charge. If it is 3 months, 4 months, like that.
All right.
It is based on the cost of funds of the bank. Right? The one I was talking about, I was charging something like 8% or 9% at this moment.
Okay, sir.
Okay. See, Aruna, high risk, but if everything goes smooth, we are out here. When it is a personal guarantee, I have to go to courts, go against him, prove that, and the court needs to allow us to collect. Right? It is a long process. This is 3 months. If we give it to the right person, we take our money and the profit within 3 months. Right? Is it clear? Okay. Right? So it is the pledge. Any other questions? If no, this is the pledge. Pledge is the bailment of goods as security for payment of debt or performance of a promise. Bailer, it is the pledger, the person who delivers the goods, the customer or the borrower. Bailee is the pledge, who is the bank. Ownership, borrower, possession, bank. Right? Then we have hypothecation loan. Here, bank will not get money. will not get the ownership or the possession. It is, we have given money, goods are with them, and it is equitably assigned to the bank, right? If customer does not pay and we say that you need to return the goods to the bank, they are bound to return the goods. Hypothecation loan, but these days we don't use this kind of products because it is very cumbersome. We have a lot of paperwork, right? Therefore, we don't use hypothecation loans. Money should be gone to the buyer. All documents should be signed, each disbursement like that. Therefore, we don't use, but hypothecation loan means we are giving out money, goods are with the customer, ownership is with the customer, but if he defaults, we can call the goods and they are bound to give that money. The goods remain in possession of the borrower and are equitably charged to the lender under document signed by the borrower. He, however, binds himself under the hypothecation agreement to give possession of the goods to the lender when called upon to do so. අපි ඉල්ලුවාම බඩු ටික ගෙනල්ලා දෙන්න ඕනේ. Otherwise it becomes a criminal offense. Right? That is hypothecation. Okay, then I have the longer one, trade finance. I will do it next week because it takes little longer. Right? Right. Any questions? I'm done for today. I would like to answer your questions. If you have questions, you can ask me. I will be here for 1 or 2 minutes. Right? Otherwise, thank you. Samindri, what is the gray area? Do you want me to re-explain it? Is its theory similar to TOD? TOD is temporary overdraft, where you have a limit for a very specific period of time. Within that period, you can use and settle. But here in factoring, it is more detailed. Because when you grant a TOD, you don't know what is your end use of money. Right? How we will pay, we don't know. But when it is factoring, we know from whom this money is coming, when this money is coming. And we can control to whom this money is going. Like goods are sold. Basically, bank is controlling the customers, clients' sales. If he sell to non-approved customer, we don't bother. We are not giving money. Whereas TOD, it is just a blanket approval to use money. So before giving out money, we will look at all list of customers. Then we will evaluate each customer. We will place limits to each customer. Only if my customer sell goods to the approved customers, we will give money. Otherwise, we will not give money. Is it clear? Or you want more clearance? Okay, right. Thank you then.